Understanding Debits and Credits, a Beginner's Guide. What's up, everyone? Today we're tackling one of the most confusing topics in accounting, debits and credits. And I'm going to break it down in a way that actually makes sense. By the end of this video, you'll understand not just what they are, but why they work the way they do. Let's jump in. So first things first, let's clear up some major confusion. A lot of people think debits are bad and credits are good, maybe because of how your bank statement works. But in accounting, that's not how it works at all. Here's what you need to know. Debits and credits aren't about good or bad. They're not the same as adding or taking away. They're actually just a system, a way of tracking that every financial transaction has two sides. Think about it like this. Money doesn't just appear out of thin air, right? If your business gets cash, it has to come from somewhere and go to somewhere. That's the whole foundation of accounting, tracking both sides of every transaction. Here's a better way to think about this whole system. Imagine every transaction as a flow of value moving through your business. Accountants call this economic benefit. Basically, anything that has value and could eventually turn into cash. So when economic benefit moves, it's flowing from one place to another place. And here's the key. The place it's coming from, that's your credit. The place it's going to, that's your debit. Let me give you a quick example. Say you buy a laptop for your business with cash. The economic benefit is flowing from your cash account to your equipment. Cash goes down, credit. Equipment goes up, debit. Two sides, same transaction. Now let's talk about which types of accounts get debited and which get credited. Accounts that increase with debits. These are where economic benefit flows to. Assets, things like cash, equipment, inventory, or money people owe you. Expenses, when you pay for something like rent, supplies, or salaries. Dividends, when the business pays out money to owners. Accounts that increase with credits. These are where economic benefit flows from. Liabilities, money you owe, like loans or bills you haven't paid yet. Equity, the owner's investment in the business. Revenue, money earned from selling products or services. Notice I said increase with, because these accounts can go up or down. A debit account decreases when you credit it, and a credit account decreases when you debit it. All right. Now let me show you how this all fits together mathematically. You might have heard of the accounting equation, assets equals liabilities plus equity. But we can actually expand this to see all the account types. Here's what it really looks like when you break it down into its pieces. Assets plus expenses plus dividends equals liabilities plus equity plus revenue. Everything on the left side, those are debit accounts. They increase with debits. Everything on the right side, those are credit accounts. They increase with credits. This equation always has to balance. That's why it's called double entry accounting. Every transaction touches at least two accounts, and the total debits always equal the total credits. Now here's a trick to help you remember which accounts are debits and which are credits. Just remember the word dealer. D, dividends. E, expenses. A, assets. L, liabilities. E, equity. R, revenue. The first three, DEA, are your debit accounts. The last three, LER, are your credit accounts. Anytime you forget, just think dealer, and you've got it. All right, let's wrap this up. Debits and credits are just a tracking system for the two sides of every transaction. Think of them as tracking the flow of value. Debits show where it goes. Credits show where it comes from. Remember dealer to keep the account type straight. Once you get this concept down, the rest of accounting starts to click into place. If this helped you out, smash that like button. Got questions? Drop them in the comments. And subscribe if you want more accounting tutorials that actually make sense. Catch you in the next one.